Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain and Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. My name is David Blain. We thank you for joining us today. We've got a great show in store for you. We're going to talk about some investment strategy items. Number one, how to craft your own investment strategy. But before we do, there's a couple of news tidbits that I thought you might be interested in. The first comes from an article back on March 9th from Investment News, which is an industry publication. Reported Morgan Stanley Smith Barney, the largest U.S. brokerage, was in the process of laying off 300 advisor trainees and other low producers. And on the surface, this story doesn't seem that important, of course, unless you're one of the 300 people getting laid off. But the story underscores a point that we made in a couple months back, both on the show as well as in some printed material, that compensating advisors based on their volume of financial products that they sell is a conflict of interest, and really is not the way that you want to get your advice from an advisor. So one of the things that Morgan Stanley was calling these weaker producers and trainees based on gross annual production. And the key to this, and why I bring this up, is nowhere does it say anything about how well these people were serving their clients, what sort of certifications they have, or anything of that nature. A brokerage firm as big as Morgan Stanley, they could certainly train people, but what they're looking for is salespeople. And in fact, the investment, if you read the laws that relate to stockbrokers, they are legally referred to as securities salesmen. And so this article just highlights, and this is nothing against Morgan Stanley, you know, they have to keep their profits up, and certainly not against the people that are being laid off. It's just a comment on the system that we have that compensates advisors based on some sort of production number, and we happen to think that that is an inferior way to do it. Of course, any of you that have been listening to our show or know our firm at all know that we are a fee-only advisory firm. Been fee-only for 12 years now. There's not that many fee-only firms in the country. There are certainly people that practice ethically and honorably, but the majority of the firms out there have some sort of conflict of interest, which a fee-only advisor aims to eliminate as many as possible. So enough on that. We'll move on to the next topic for this morning. This is related to investment strategy. And you'll hear us talk about on the show, and if you are a client of ours, you'll hear this all the time, is that we invest for the long term, but we pay attention to what is happening in the short term. And that the days of your father or grandfather, depending on how old you are, of buying a company like AT&T or GE or something and holding it forever are over. And if you think that that is the path to wealth, it's probably not going to be a big pot of gold at the end of the rainbow. There's business changes too fast today. A lot of the growth is happening overseas, and we recommend that people move into a little bit more with a strategic and a tactical focus based on what is currently happening in the marketplace. And there's no harm in taking some profits off the table every now and then. Once again, we're not talking about day trading or, holding stocks for a week or anything, but certainly over a number of years, stocks can lose their luster, and in fact, you can have the permanent impairment of capital. We're going to cover in another show what I call the 7 immutable laws of investing that a colleague of mine, James Montier at GMO, originally came up with, and one of them is that to avoid the permanent loss of capital, and this is one of Warren Buffett's big things. You've heard this before as well. The first law of investing is don't lose money, and Warren's second law of investing is don't forget rule number 1. And when you're dealing in individual securities, this is certainly a possibility. The entire U.S. stock market going to zero and staying there is a very minute possibility. So if you invest using mutual funds or exchange-traded funds or something that you diversify your portfolio, even 15 or 20 stocks would be better than one. I had somebody come in the other day, a new client who came in, and he had a 401k where he was investing 100% in his employer stock. So he was deferring, the maximum around $15,000 a year, and he was putting it all in his employer stock. A big mistake. Ask anyone who worked for Enron. Then we moved over to his personal portfolio, as well as education savings accounts for his kids, 3 of them. And in those 4 portfolios, he had one stock. One stock in those 4 portfolios plus one stock in his 401k. So basically, his entire financial future was resting on the fortunes of 2 companies. One that he worked with and his whole 401k was in, and number 2 in one other stock. And this particular stock was a high flyer for years and years, and then just got decimated in the latest meltdown and probably will stay there. Its industry has been permanently changed. It will probably never recover. It paid a big dividend, and so a lot of people invested in it for that big dividend. Well, guess what happens when companies start losing money and they have a big dividend? The first thing they do is they cut that dividend. So now this company has no dividend, and its growth prospects are severely impaired. So I'm telling you this all to lead up to a story that appeared way back in August of 2000 in Fortune magazine. And this is not to pick on Fortune magazine. If you read it, if you like it, I'm sure they have some good articles. I personally don't really read it. But back in August of 2000, they had an article about what had happened in the late 90s and how the tech bubble had created all these millionaires. And if you missed it, that's okay, because they had the answer for you. They had these 10 stocks you could hold going forward forever that were, the next greatest thing, and all you had to do was buy these companies and you would be all set. Well, you know the end of the story, that it didn't quite work out that way. We're coming up on a break here, so I don't want to steal the thunder for this story, because it's a great story, and I'm going to read some of it to you, because it's fascinating if you go back and read what is written at different time periods in history about people that get caught up in fads, and then to go back and see how they actually worked out after the predictions were made. You'll find that very few people, and certainly not the mainstream journalists, are able to make accurate predictions. So when we come back from the break, we'll talk about this article a little bit more. So for All Things Money, I'm David Blain.